going on, everyone? Thank you for subscribing and thank you for tuning in. Today, the purpose of my video, I just want to walk you through the basics of what a call option is. Now, a call can be bought or sold, but today's example, we're going to touch on buying a call, being long a call, which in turn means that you are bullish. You want and need the stock price to increase, to benefit, and also to make a profit. Okay, now option strategies take place in just about any industry around the world, not just in the stock market. It takes place in the insurance industry, it takes place in real estate, even in the sports industry. You're ready to jump in? Let's get to it. You've gotten an idea on how a call option was used to buy an NBA team, I want to walk you through how you can use that same call option to purchase stock. Now, of course, before we dive deep into options, we need to know what stocks are. Now, stocks, in this most basic definition, is a type of security that gives the holder a share of ownership in a company. Another word for stocks can be equities. And there are two types of stock. One common, another preferred. I will touch on the difference between the two in a later video. Now, of course, when it comes to buying stock or shares in a company, you want to do so in quantities of 50s and 100s. That way you can get a larger percentage of the business. You can receive larger dividend payouts if the company does pay dividends. And also you can receive a larger portion of the profits from the growth of the company. Okay. Now, of course, when it comes to purchasing stock, it can be very expensive, especially nowadays when you have companies that have stock prices in the thousands. Now, there are some benefits to owning stock, obviously, if you do want to have ownership equity or ownership interest in the company. But at times, there are people who do want to get invested into the stock market, and it can come off as being very expensive when it comes to buying shares in quantities of 50s and 100s. But there is a solution, the call option. Now, the call option, of course, going into it in its most basic definition, a long call in this case, the call buyer, this is going to give the buyer the right to buy an underlying security for a specific price. And that specific price is going to be considered called the strike price. Now, one call contract equals 100 shares. So that's going to allow you to control 100 shares of the underlying of your choice for a specified amount of time that you and the seller agree upon at the price you all agree upon. Now, what are some pros to being a call buyer? You're not obligated to buy the underlying security. You are going to have time to make a decision to make sure that this is the right investment for you. Your losses are capped. Now, when I say your losses are capped, you do pay that premium, you do pay a debit to the call seller, and you cannot lose any more than that. You have unlimited profit potential. In regards to the stock price can continue to go through the roof, and you're still going to have that benefit by profiting off of the increase in stock price. You have an option to close or exercise the position before expiration. Because you are the call buyer, you have the right, you have rights, you're not obligated. Okay, so you call the shots until the contract expires. And it is very cost effective. Now, when I say it's cost effective, you're not going to have to come out of pocket for hundreds of shares worth of the value, which is also going to create an opportunity to give you increased ROI potential. That return on investment is going to be a lot higher because of how very little you came out of pocket. Now, of course, with pros, there are cons. When you are a call holder, you are not going to have any ownership equity in the underlying. Remember, you're just controlling the shares, you control the contract. So you're not going to receive any dividends throughout the duration of you holding the contract because you don't own the shares. The contract will expire. So you have to make a decision within the time frame of that contract. Like I said, you don't collect any dividends while holding a contract because you do not own the shares. Your premium is going to lose value daily. And this is because of time decay, which is one of the Greeks called theta. And I don't want to get too complicated with this because we're just touching on the basics, but keep that in mind. Now, of course, the pricing factors. You have two types of pricing models in your options premium. One is going to be intrinsic. Now, intrinsic is going to be the difference between the stock price and the strike price. Let's say, for instance, if the stock price is trading at $60 and your strike price is $57, you have $3 of intrinsic value. You also have extrinsic value, weighed heavily by time and volatility. And now that I've touched briefly on the pros and cons of being a call buyer, I want to actually show you what it looks like, the difference between a stockholder and also a call buyer. And I also want to show you how you can buy a call option. Now, please excuse my chicken scratch, but the example that I want to use Delta Airlines. So Delta closed at $58.96. Now, this here is the stockholder. So if the stockholder wanted to buy 100 shares of Delta, they're coming out of pocket $5,896. Okay? Now, let's say the stock price increases by $2. That is going to be an increase of 3.33%. Okay? The stock price would then be $60.96. You have your 100 shares. You multiply your 100 shares by $2. You're going to have a profit of $200. Good job. Congratulations. So now you're going to have $6,096. Right? Like I said, you still have your 3.33% return on investment. Now, what does that look like for the call buyer? We're going to use the same company, Delta Airlines, but what we're going to do is we're going to lock in a strike price of $57.50. Now, of course, the debit paid, we have to pay a debit to lock in that price. Debit paid is $2.85. One call contract, remember, if we're going back to the definition, one call contract is going to give you the opportunity to control 100 shares of this underlying. So you multiply your premium, your debit paid, by 100. So you're only coming out of pocket $285 versus the $5,000 to own the 100 shares. So we're controlling 100 shares for $285. Cut that cost substantially. Now, we do have to keep into consideration Delta. Now, Delta is going to change daily, but I want to use the most basic example. Delta is 0.63. Delta is going to give you the amount your premium is going to increase or decrease by per every $1 move in the stock price. Remember, our stock price increased by $2. So Delta is going to increase by $1.26, 0.63 times $2. Remember, our premium, our debit paid is $285, so you have to add that to Delta. And I left out every other pricing factor that is included in the change in the premium to keep it simple. So now our premium, our debit paid, is now worth $4.11. That increase is actually 36%. You multiply that by 100, we now have $411. So you now see the difference in your return on investment. It goes back to one of the benefits of using call options, because it gives you an increased ROI potential, that increased return on investment potential. So you came out of pocket $285 and you made a profit of $126. You made a profit of $200, but you had to come out of pocket $5,800. So that gives you a perfect, well, I wouldn't say perfect because we didn't use all of the factors, but that gives you an idea on why you should buy options more than you should buy stock. Now that I've shown you what it looks like in regards to the numbers, like I said, that isn't a perfect example because I did leave out some factors, but just so you can grasp a basic understanding on the numbers, the difference between return on investment with stock versus options, I want to show you how you can buy your first call option. We're going to use Delta. This is not a recommendation nor a suggestion in regards to just saying you should buy Delta stock or options. This is just for informational and educational purposes only, okay? So of course, in order to trade options, you do have to have an approved account with a brokerage firm. You do have to go through an application process. Don't be intimidated. It's just like filling out an application for a bank or a checking account, okay? So of course, you're gonna need an options chain. An options chain is gonna give you everything that you need to know in regards to your dates and your strike prices. So you can go all the way up to 2022. You can lock in a stock price today and have an option to buy or exercise all the way up to 2022. We're gonna use 43 days. This here is gonna give us our strike prices. Now, when buying calls, you want the contract to expire in the money. Now, you don't have to hold it all the way until expiration, but you do want that contract to be in the money. You want the stock price to be above your strike price. That way you can have that intrinsic value. Now, the options chain here, what I am going to do is just show you an example of a strike price of 57.50. The stock price is trading at 58.96. So we have some intrinsic value because the stock price is above our strike price. We're going to pay a debit. We're going to hit the ask. We're asking of $2.85. Remember, one contract equals 100 shares. So we're going to pay $285, and that is our debit. Now, when it comes time to pay a debit or buy an option, we're going to need that stock price to move to a certain point just to get our debit back. And that's where you see this gray area here. We're bullish. You see the stock price needs to increase. But that is why calls or buying options have a lower probability, because you need the stock price to move to a certain point just to get your debit back. Now, I hope this makes sense. I hope this isn't too complicated. I wanted to keep it basic, but I also just wanted to point out how simplistic it is to get into trading options. Now, of course, as time goes on, I'm going to continue to release more videos, digging deeper and get more into the intricacies of buying and selling options. But I wanted to just scratch the surface and keep it as basic as possible for the first video. Thank you so much for tuning in. Thank you for your support. Comment, like, subscribe, share this. I appreciate everyone. Ask any questions. Peace.